Welcome back to the Retirement Fiduciary Podcast, your classroom for no BS financial education. A place where we have authentic discussions about retirement planning, investment management, tax reduction strategies, insurance estate planning, and more. Here's your host, Adam Koch, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group.
Hey, what's going on, everybody? Welcome to the podcast for this week, bi-weekly, as always. This time we're going to talk about how to profit from your losses, or in other words, making sense of tax loss harvesting in your retirement portfolio. And if you're going to do this, well, first we want to know about the facts, what's good, what's bad, what do you have to pay attention to? And then we're going to talk about how to do it the right way. If you're going to do it at all, how to do it the right way. That is, if the professional you're working with isn't doing it for you, obviously you could be doing it yourself. So let's just jump right into the meat of the material today. The quote of the day is actually from Investopedia, and it goes like this: "Your after-tax returns matter more than your pre-tax returns. After all, you don't spend your pre-tax dollars." Right? So at the end of the day, it's not what we make, it's what we take home, right? At the end of the day, after taxes, and really one could even argue after inflation as well, but we're just talking about taxes today. So what we're talking about is something called tax loss harvesting, and it sounds strange, maybe it's a little nerdy, but basically we're talking about a tax strategy that's used in investing, and the goal is to try and avoid paying tax come tax season the following year by basically trimming investments you own that have unrealized losses to wash out gains from earlier in the year. So essentially, this is how it works. So the first thing you want to do is you want to identify losers in the portfolio. This is typically going to be done toward the end of the year, typically maybe in like late November, December even, but typically later in the year, in December. And you want to find out, which investments do you have in your portfolio that are down in value? And then from there, you will take those losers, or some of them. You can just sell all of them. Obviously, you can sell some of them, but you sell the losing investments in order to realize the loss. Or said another way, when you have investments that you own that are down in value, those are called unrealized losses because technically they're not losses until you sell them, technically. So by selling them, you essentially realize that loss. And then by realizing that loss before the end of the year, you can use that realized loss to offset or wash out gains from prior in the year. So if I say this another way, essentially if we have some investments that we've sold earlier this year, we've made some money on those investments, and if nothing else changes between now and the end of the year, what we would have to do is pay capital gains tax, whether that be long-term or short-term capital gains tax, or both, on the gains of those investments if nothing changes between now and the end of the year. Now, if the market, in situations where this makes sense from time to time, it's typically when the market has had a good first 2 or 3 quarters, but then has a tendency maybe to have a bad fourth quarter. So if the market goes down in the fourth quarter, and maybe the investments you own aren't necessarily bad investments. It's not like you don't like the investments. It's not like you wouldn't otherwise sell them. But because they're temporarily down in value because of the whole baby in the bathwater thing, so the market goes down, as the saying goes, I think it was Warren Buffett who said, "The rising tide lifts all boats." And when the tide goes out, we can see who's swimming naked. But basically, when the tide goes out, or when the market goes on as overall, what ends up happening is we end up seeing all investments go down in value. Not literally all investments, because obviously not every single investment on the planet goes down in value, but many investments end up going down in value because the market went down. So when that happens in that fourth quarter, what we can do is we can sell some of those investments to take those losses and then wipe out some, if not all, of the gains from earlier this year. So if we use a real life example, and I'm just going to share with some math with you here, and let's just say earlier in the year we have $100,000 in gains. So in other words, we'd sold investments earlier in the year, we've got $100,000 in gains, and now we're sitting here in December, and the market's gone down for, let's just say, 2 or 3 months, and now some of the investments we have are down in value, and we'll just say that total is $30,000. So if we sell those investments, now our gain that was going to be $100,000 from earlier this year, we take $30,000 out, and now our new taxable gains are $70,000. So we basically take the $100,000 gain, we sell some investments, we take the $30,000 out. Now our net new gain, or in other words, the amount we have to pay tax on, has now gone down from $100,000 for the year for tax season down to $70,000. So our new tax liability at 25%, I'm just using easy numbers here, between federal capital gains tax and state capital gains tax, because you do have to pay capital gains in your state, by the way, and they're different. Every state's different, has a different capital gains rate. So your tax liability on $100,000 was $25,000. But now that you've reduced your tax liability from $100,000 to $70,000 by selling investments that were down $30,000, now your new tax liability is $17,500. So at the end of the year, what this does now is it saved us $7,500 in taxes that year. Now here's the catch. The catch is you have to follow something called the wash sale rule, which means you have to wait 31 days before you can buy back the investments you sold. Otherwise, you cannot use this strategy. So you have to basically, and this is where it gets tricky, is most people think, well, I'm going to sell these things. I'm going to leave it sitting on the sideline, basically in cash. And then 31 days later, I'm going to buy it back. And then now I can be back in the investment that I owned before, even if I like them, right? So the problem you run into is oftentimes we'll say, well, what if the investments start to come back? In other words, what if I have to pay more to buy those investments back in the month that I sat around waiting so that I could take advantage of this tax loss harvesting technique? And it's a valid concern. It's definitely a problem. And so, when we go over this strategy, the main complaints here is, first of all, that the average investor, studies say that the average investor only saves around 0.3% in implementing tax loss harvesting. And then the other thing that people worry about is the gains that you realized during the wash sale period erode the benefit of the strategy versus just staying invested. So in other words, instead of selling those investments and taking the loss and saving $7,500, what are the chances, and this is just a question, what are the chances that $30,000 goes up by $7,500 or more, thus essentially wiping out the strategy's purpose at all? So it might not have made sense, right? So obviously we don't know. We can't predict the future. We don't know if the market's going to come back and at all, let alone within 30 days, and how much it's going to come back in the investments that you own if you implement a strategy like this. So the secret to overcoming these pitfalls is, first, don't sit in cash, especially if the market's starting to gain traction. In fact, a lot of the times the investments that actually start to pull back and correct, even if the whole market isn't correcting, tend to be small caps in December. And then what ends up happening is when people are taking advantage of this tax loss harvesting strategy, we start to see buyers come in and start to push prices back up toward the middle to end of December, which is, again, where you could be sitting on your hands while you're watching the market, and not to mention the stocks that you did own that you sold go up in value while you're sitting on the sidelines. So the first thing is, don't sit in cash. Don't just let it sit in cash during that entire 31-day period. So you might be asking yourself, okay, well, that's fine if I don't sit in cash, but what am I supposed to invest it in then? Because again, if I sold a couple stocks that to take advantage of tax loss harvesting, and I can't buy them back for 31 days, what do I just buy anything? And the answer to this question, at least what we like to do, is let's just say you sold an ETF and you are waiting 31 days to buy back that ETF. What we could do is you could look at, say, the top 5, 10, 14 stock holdings within that ETF, and you could buy the individual stocks inside the ETF. Now, you're probably not going to want to buy every stock in the ETF because some ETFs can have 50, 60, 80, 100 stocks. But you could buy, the biggest holdings, which make up a good percentage of that ETF. Furthermore, you could do the opposite. If you sold stocks to take advantage of tax loss harvesting and you can't buy those individual stocks back till 31 days later, then instead what you can do is you can look up the ETFs that have the highest percentage holdings of the stocks that you own in order to remain exposed. And again, it's not going to be perfect. You're not going to have 100% of the stock or stocks that you sold, but you're going to have a percentage of them plus a good probably percentage of the sector or industry group in question, which means that if the market does start going up, or the stock starts going up, or stocks as a whole start going up in value while you're sitting around waiting for that wash sale rule to expire, then you're still exposed at a time when the market starts to regain traction, let's just say. Now, once the 31-day period is over with, understand that you can then turn around and you can sell the investments that you repurchased for the sake of staying invested and staying exposed, and then turn around and buy the stocks that you had before, or vice versa. You could buy the ETFs back. So during that 31-day period, you're basically just reinvesting in something else that is similar, not the same, but similar. And then the goal, of course, is to stay exposed or stay invested to the percentage that makes the most sense for you based on your portfolio, your risk appetite, your financial plan output, and thereby avoiding the problem that results from sitting around on the sidelines while the market's going up, while at the same time saving some taxes in the process. So that's pretty much how the process works, and I can't reiterate more. All of this is, I don't want to say worthless, but it's definitely not as worthwhile without a written, comprehensive financial plan. So if you don't have a financial plan, you got to get a plan. I mean, first and foremost. So if you don't have a plan, get one. If you have a plan, have it reviewed at least once a year, once every 2 years, depending on how good the review was last time. And of course, if you have any questions about this, financial planning, getting a retirement plan done for yourself, you can always reach out to us at any time to set up an intro call. We usually do 20 to 30-minute intro calls just to kind of go over how we work with our clients, what we do in terms of the financial planning process, what that looks like, and we'd be happy to go over any questions that you have confidentially, easy for me to say. So if you want to get a hold of us, just reach out at info@libertaswealth.com. You can just go to our website at libertaswealth.com. There's a couple buttons you can click to say click if we're right for you. And if you're a business owner, be sure to check out elevateandexit.com, our sister company, which focuses on helping owners increase profits, increase efficiencies, reduce the amount of time required by the owner in the business, de-risk, create continuity, and essentially increase the enterprise value of your business so that you can have more fun, enjoy more work-life balance, and eventually one day down the road sell the company. So that's all I've got for the day. As I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much, and I'll look forward to seeing you next time.
Thank you for joining us on the Retirement Fiduciary Podcast. To see any charts or images that were mentioned on this show, to check out additional articles, videos, and other educational resources, or to set up an intro call with your host, Adam Koch, just head over to libertaswealth.com. This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. None of our shows engage in rendering legal, financial, tax, or other professional services. Always talk to a certified financial planner or fee-only fiduciary financial advisor before implementing any of the ideas shared in this episode.